Hey, everybody. This is Paul Crammy again. Welcome back to our second session of this two-part series. Today, we're going to switch our focus from pricing to financial analysis, and we're going to look at just a very small handful of PowerPoint slides. We're going to look a little bit at answering some questions. And then we'll look again at a sample analysis that was recently done for a client. I'd like to make the same kind of introductory comment that I did on Tuesday, that these pricing and financial can be very complicated, involve a great deal of time, and it may be more than you are capable of handling internally in your own business. On the accounting side or on the financial side, if you have an accountant, they can probably do a good portion of what we're going to be talking about today. But if you don't have that level of expertise, then it might be appropriate to consider having this done on a consultative basis outside of Sirius. So with that said, I want to switch gears. Oh, before I forget, my contact information is on this screen that you're looking at, and then there's a handout that if you go down on your GoToWebinar screen under handouts, you'll see that there was a handout from the Tuesday session, as well as today's session. Linda, I don't see them on here. They were there Tuesday. I wonder if they need to be added to this session too.
They do. I'll do that quickly.
Okay, sorry about that, but there is a handout for today's discussion. So let me switch my view here just a second. Okay, you should be seeing the PowerPoint thing. Just a couple real quick comments. I have had about 10 years or so experience in the sign industry. Sold my business in 2003 when I retired, and I've been doing work with Sirius pretty much since that time. In 2009, Scott and I were asked to do a presentation to a national franchise. And it focused on a lot of the things that we're going to be talking about today, determining labor rates and things of that nature. So that kind of stimulated my thinking on what kind of tool might be helpful, for customers to have access to determine their labor rates, what their overhead rates are, and what are the equivalent full-time equivalencies in the various areas of the business. Now, most of my contacts for engagements come from either my website. Most of them, however, come from internally within Sirius, when the consultants or the tech support staff are working with someone that has a question or a concern dealing in more detail about profitability and labor rates and overhead rates. They will often refer those people to me. It's not that Sirius can't do it, but I've got a little bit more of a business background, as well as some awareness of control itself. To date, I've done 24 I worked with 24 clients for a financial analysis, and over 30 engagements. So now I want to switch gears, and we're just going to look at a few key important questions that might help you determine if a financial analysis would be helpful to you. These are questions that have been often raised to me when I have discussions with folks. Do you have any concerns or any doubts about your business's profitability? I find that a lot of people really don't know or don't understand what affects their profitability, the cost of goods, the other operating costs and sales, et cetera, et cetera, et cetera. So if you would answer yes, to either of those questions or both, then a financial analysis might be of benefit to you to consider. The objectives of a financial analysis are very simple. We want to help set the stage for improving profitability. And improving profitability is going to entail hopefully increasing sales, but at the same time, it's going to be necessary to reduce some of your expenses, either cost of goods expenses or variable expenses or fixed costs. You can't simply increase sales. You can increase the dollar value of a net profit, but you can't increase the net profit as a percent of sales without a combination of increasing sales and or reduction in the various costs. Now, the benefits of an engagement, of an analysis, we're going to identify about a half a dozen, what I term, these are my terms, key performance measures that have a direct influence on profitability. The results of an analysis are going to be some things that we can immediately do in control. Again, using my terminology, to tune control. And this is going to focus on labor rate values, as well as the multipliers that go along with those labor rates. Financial analysis consists of collecting data from the client. There's just some very simple general information. What kind of date range are we going to cover? How many days are you closed during the course of a year? How you want to handle cost of goods for certain kinds of expenses, and then what kind of sales groups I can accommodate up to 4 different buckets, so to speak, of sales and cost of goods. Then we're going to gather some employee information. The number of hours that a person works in the production area or in the sales area or office and administrative area. We need to be able to determine the full-time equivalencies by these various areas, because that's going to help determine how the labor rates and the overhead rate is calculated. That is all imported into the model. And then the results of that, after some interaction with the client, that's going to there'll be a narrative report, assessment report created, and it's more of a set of recommendations for what you might need to consider doing as you prepare an annual operating plan. Areas that you need to focus on, areas that you might need to make some improvements on. And then we're going to, as I said earlier, we're going to focus on some labor rates and multiplier values for the labor pieces. There's a series of reports, and that's what we're going to look at when we look at the sample. So that's really it on from an overview. Now I'm going to switch to a recent engagement, and we're going to walk through this very slowly. I'm not going to go into the details of how things are calculated. I simply want to focus on the results and some of the important things to look at. This first page that we're looking at is just the general data that is needed. How many days are you closed for holidays, vacation days, sick days average? What your estimate is for your hours of productivity. The analysis can handle up to 2 different time periods. So generally, someone will obviously start with the first one. And as you can see on this one, the first one was done in 2013, and they repeated that in 2016, and they anticipate doing another one here shortly to cover 17. Down in the lower left-hand corner in the yellow area, those are the 4 different buckets that they can define. They want to separate. This is a unique customer because about half of their business they sell at cost. They're a subsidiary of a larger company, so all of their internal sales is handled at cost. So they wanted to keep that separate. That's one bucket, and then they have a more traditional section, for things that they want to make a profit on. Now we're into the guts of the results. What you see up here is view 1 and view 2. These are the 2 time periods that that they want to look at. Up under the FTEs in this first, right up at the very top, this particular client has started off last year or the first time with 3.3 people in FTEs in production, and they grew about 1 person. Shows the number of FTEs on the sales and the office administrative side. And then coming down, I want to focus a little bit on the cost of goods. It's extremely high, but keep in mind that over half of their business is sold at cost. So that's going to show an abnormally high cost of goods ratio for a customer. When you come down to the variable costs, my simple definition, these are the costs that will tend to increase pretty much in line with sales growth. The percentage will slowly increase, whereas the fixed costs, they will tend to remain relatively flat, if not even a slight decrease as the sales level grows up. And that's what you can see on this particular client. The variable cost crept up a little bit, but their fixed cost came down a little bit. Overall, they had just a very modest increase. The next section down in this R3 area, by the way, these R3, R4, R5, these are the 5 key measures that I alluded to when we first were starting. In this particular section, their overhead rate came down nicely, about $1.40 an hour. Their productive hours, the FTEs for production are productive about 5,400 hours, which is around 6.5 hours a day, and that stayed relatively stable. So their rate of growth for the FTEs is consistent with their rate of growth in sales. They're staying relatively the same. Down in the next area, in the number 4, number of orders increased nicely, 1,200 to almost 15, but more importantly, the ticket average increased nicely. The net profit, this one is interesting for this client because of the nature of their business. They have a very strong net profit, 9.8% initially, and that has crept up to 11.5%. That's a very, very good. That's a very good growth rate. Now down in the this area here, this is more labor in nature. And what it's showing is that their overall percentage of benefits, which would include taxes and medical benefits and other benefits, increased slightly, with most of that coming in the medical area, which is not surprising based on what everybody in business is seeing today. The average hourly rate for the tax went up about $1. The loaded labor rate with the 4790 came down from the initial engagement, which is a good sign. So they're bringing their overall labor costs down for labor and wages and taxes and benefits. Now the 2 combined, the overhead and the loaded labor rates, that also came down from 58.5 to 56.70. We'll see when we look at another thing here in a little bit. that is a little bit higher than what it may be ought to be, and that's because of these values here, the 40/50 and the 39/10. They're a little bit on the high side, for their base wages paid. Their taxes and benefits are very consistent with what we'll look at in a bit. Now I'm going to pause here to see if there are any questions, and then we'll continue on.
Paul, I sent everyone the handouts that were not on the GoToMeeting, so everyone has should have gotten the handouts in their email that they registered with.
Okay, perfect. All right, moving on. Now, this section here is in order. One of the important values, I think, of the financial analysis is the ability to compare how your particular business is performing with businesses of similar size in terms of sales. And in order to do that, I take everybody's expense stream and income stream and normalize it. And that's what we're looking at here. Now, I'll just comment just very quickly on some of these. Up here at the top is the sales, the cost of goods, their production wages. Notice that came down nicely, but you really got to add the two of these together so that they're very, 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 very similar, virtually no difference, 18.2 to 18.9% of sales. Cost of goods, as we talked about earlier, is on the high side, and that's because of the nature of this particular business. These are the normalized expense things that I talked about. So take everybody's expenses, and they will be normalized into one of these 14 categories. That gives me the ability. Is it perfect? No, but it gives me the ability to do a better job of comparing one business to other businesses. So the total administrative costs went up just a tiny bit, 1.2%, but more importantly, their net profit came up about 1.5 points to a little over 1.5 points. Now we're getting into one of this was actually triggered by a client's suggestion. I said, okay, it's all well and good. We know what our sales are. We know how many orders we have. We know what our cost of goods and variable costs. But how do we improve that profitability? And that's the focus of this particular piece of that I'm showing you. It's an interactive process that we will do jointly. So the green represents the now that just ended. So it might be for 2017, whatever the time period. And it shows that they have 11.5% net profit that we've already talked about. And they jointly said that we would like to have as a goal to increase that to 12%. So just a modest 0.5% increase. So now the question comes, how do you get there? What do you have to do to achieve that 0.5% growth? You have to do it in two ways. One, you're going to need to increase or want to increase the sales. You don't need to, but you want to increase the sales. And secondly, you have to reduce the three cost components, cost of goods, variable cost, fixed cost, by the total of the 0.53% in this area. Now, because of how this particular client compared to his peer group, the focus was to get all of that reduction in the cost of goods. I mean, you commented a couple times that their cost of goods is a little bit on the high side. So we said, well, from a target plan, let's aim at reducing their overall cost of goods by that 0.5%. Then down at the bottom, the client said, I think it's reasonable for us to strive to have 2 additional orders per month, or per week, I'm sorry. So a total of 104 orders. And based on some of their historical growth in the average ticket value, they said that they felt that it was reasonable for them to strive for a 4.7% increase in the average ticket value. So all of those together says that the number of orders is going to go up from 1492 to 1596. That's the 104. And the sales are going to go from 1.54 to 1.7. That represents the 4.7% growth. And then the costs are going to be held static at these percentages for the variable and the fixed. And the cost of goods is going to come down from the 73.6 to 73.1. That's going to produce a net profit. Now, this is a plan. This represents a plan. Is it a guaranteed plan that it's going to increase? No, it's not. But it gives the framework for a client to present, to develop an operating plan that might be of help to them. Now I want to pause here again to see if we have any questions or comments.
No questions or comments.
All right. Now these next things this is the narrative report that I've alluded to that everybody will get, and it takes each of these 6 measure sections and talks about them, what's included, and then each of them have an analysis, observations, and recommendations. This is where in the report it's going to focus on areas that they might need to focus on or be aware of, or in their planning strategy for market or for their operating plan to focus on. So anytime I have a recommendation that I want them to pay attention to, I've tried to highlight it in red. So I'm not going to go into that, but that's the purpose of this narrative report. It gives them some concrete things to consider as they begin to manage their business. I'm just going to scroll through this so you can kind of get a flavor of the areas and the depth, some of the discussion. Now these 2 pages here, these remaining pages are going to be part of the handout. So they're kind of small, so don't. Let me see if I can increase the size a little bit. I don't know if I can. This is, that didn't work. Okay, I'm not going to try to wipe the GoToWebinar. It doesn't like to have that played around with. But what you're seeing here is how I compare your analysis with others that I have done. So on the first 2 columns over here, this represents the results, the average results of everybody. This represents this particular client, the one that we just looked at. The different peer groups are, first group is up to $500,000 in sales. Second group is from a half to a full. Third group is 1 to 2 million, 3 to 4, or 2 to 3, 3 to 4, 4 to 5. So it compares. So this particular guy had sales of 1.5 million. So he's being compared to this group over here on the far right. And as we went through, it gives the client gets, this is a deliverable as to the client, so they can see visually how they are stacking up. So notice here the FTEs for production 4.2. The others in that group were 6.2. So he's doing a good job as far as the number of full-time equivalents. You know, full-time equivalents are going to go up in a stair-step fashion. You're going to reach a plateau where you're probably doing too much overtime, and then you're going to have to ratchet up the number of FTEs, and it's just going to kind of continue in that kind of pattern. Notice the overhead rate down here in the middle of the screen. His was 9. That is an extremely low number. Most of them, the overall average is around $24 an hour, goes up to 28 into 20. So this number is low, is on the low side, which is good. But if you come down to here, his labor rates are on the high side. He's 48, where his peer group is 30. You know, so the overhead and the labor rate combined is only modestly off from that of everybody, you know, those in his peer group. But the purpose of this is simply to give the client an opportunity to see their results and how those results stack up and compare to similar size stores in businesses in terms of sales. Now these next two, I'm going to reduce the size of this a little bit. This is the normalized thing, same thing that we just talked about. This is a comparison of all of the operating expenses in these 14 buckets and how you compare in those areas. Now, this is I hope you can use it as a frame of reference. This is expressing sales and all of the expenses as on a per dollar basis. So we've got $1 of sales. If you're in the $500,000 or a 1 to 2 million range, this suggests that the clients, the 32 have in that area, have averaged about 56 cents per dollar for cost of goods. So the gross margin's 44. These are the different expenses then, and how they might, and then the overall average in that 1 to 2 million range is 88 cents, 8.4 cents per dollar is the net profit, or net 8.4% would be the net profit ratio for that particular category. This one is a little bit more specific. This is kind of a summary of the 32 engagements with in terms of expressing the full-time equivalencies. Again, so just look at the column that would fit your particular bucket, and you kind of get a feel for how many FTEs there might be in that area. This number here, the 209, that says that each FTE is essentially producing or processing $209,000 of sales. The sales, 2.3 of them, they're producing about double that, 596,000. The administrative side and overall, so they all together they have what, 11.3 FTEs, and on average they're pumping 124,000 per FTE out the door. The ratios of variable and fixed costs and overall operating expenses. And notice that they stay relatively static across all the different size shop segments. And then the last piece down here, this is the overhead, and this number has really kind of surprised me at how static it remains in that 24, 25, maybe as low as 20. That's the reason that this particular client, that the $9 level is very low, but that's offset by a higher ratio down here in the loaded labor rates. The percentage for taxes and benefits also stays relatively stable at around that 16% range. For newer clients that are getting control, the labor rates pretty much are set at $45 an hour, and that to a larger degree was developed based on what this chart is that we're looking at the $45 range. So your hourly benefit, loaded labor rate, and taxes and benefits is 20 bucks of that. Another $4 of that is hourly benefits for taxes, and then the remaining 24 is the overhead component. Now, not everybody's will be the same. They should be reasonably close to that, but the intent of this is to give everybody as a takeaway, to give them a flavor of what you might expect to see in your current business. And you can use this to look at your current labor rates and see how you're handling those in your shop. I have covered all of the material. Now I'm hoping that there are some questions and comments.
Are there any questions or comments? No, Paul, there's no questions or comments.
I hope I don't want to keep anybody longer. We did have a question on Tuesday that I didn't answer. I'm going to take the liberty of going back to I'm going to open up control. There was a report that we discussed on Tuesday. That I want to go to, which was one of the main reports that the pricing evaluation gets its data from.
And just to let everybody know, this session is being recorded, so you will be receiving the recording of the session later this afternoon. We do have a question from Barry.
Okay.
Paul?
Hi, Barry.
I'm going to unmute Barry. Going through the material comes at us very quickly and tough to grasp. Ask Paul. Go ahead. I'll let Barry ask his question.
Hi, Barry.
Hi. The information you provided is excellent. It's a whole lot to absorb on a short basis. Is there a possibility of possibly getting a copy of what you presented to us today? To see the format and pick out some of the numbers? Not the sample stuff.
What I would prefer to do, Barry, and this applies to anyone, yes, you're absolutely right. There was a lot of data that was thrown at you. My preference would be to schedule a session, half hour, 45 minutes, an hour, whatever it takes, so that I can slow down and be more one-on-one with you to answer questions and show you. I can't really share the results data at the client level, but I would be delighted to connect with you on a private basis, or anyone on a private basis, to review that more in depth.
Okay, the challenge still remains that you've got a number of parameters of which you've developed, and all of which are very good and very direct and very positive. The key is I don't know all those parameters, so for us to carry on a discussion for half an hour or so without me having something visually in front of me to ask an intelligent question is somewhat challenging. Even if it was a blank format, then it at least highlights my memory to ask intelligent questions related to it. In other words, if it didn't have results in it, I had more of just the outline, so to speak.
The template stuff.
Yeah.
I think the answer to that is yes. I can, because I got the model. I can just blank out the the data.
Yep.
And it still produces exactly the same format of the deliverables. Yes, I can do that.
Terrific. That'd be wonderful.
And I will make that available to Linda. Is that okay, Linda?
Yeah, that's fine.
And then you can share that with the group.
Yes.
I'm going to do just a blank. I'm just making a note to myself.
That'd be wonderful. So as I say, there's a lot of data there, and to try to convey it in a 15-minute or half an hour scenario is challenging. I'm bright, but there are limitations to that.
I will send the blank template to all the attendees on today's session.
Terrific.
It may be later this afternoon, but I'll get it to you.
Yeah, it'll take me a bit to to get a copy of it produced. The question. Let me go ahead.
We have another question.
Okay.
Thank you, Barry. We have another question from David. Ask Paul for average sales cost percent per salesperson.
Average.
And David, I unmuted you.
Average sales cost per percent of sales or per dollar of sales?
Per salesman.
Let me look. I think. Okay. Let me go back to the. I want to make sure that I'm following. What this is saying is that each FTE in sales, there are 2.3 in this $2 million bucket here. Each of the FTEs is producing roughly 600,000 in sales. Am I misunderstanding your question, David?
I don't know if I'm unmuted or not, but Paul, yes, you're right on. That's fine. Keep going.
Yeah. So what this says is that the total sales is, I think, $1 million average sales in that particular category is about $1.4 million. So each of the 2.3 salespeople, each one of them is producing the equivalent of just shy of 600,000. Okay,
and so what's it showing me your average cost for that sale? And a percentage? Are you at
the cost of the sales?
Yes.
Well,
I can take that number and divide it into the sale of 1 million, I guess.
Yeah, I'm not sure how the cost would be scaled down. The cost is 777 million. I'm just cheating here on the sheet.
Yeah.
So the cost ratio, that's a really, really good question. The 596 is based on the sales value divided by the 2.3.
Yes.
The cost component of that would be the total cost of goods, which in this example is 777 divided by the 2.3.
Paul?
Yeah.
I think what I was asking you is that in all these comparisons of all these companies, and I may want to call you after this and talk to you probably, is what is on the average companies paying their salespeople for their sales? What percentage? You know, 8, 10, 13, 15, loaded, unloaded. I haven't seen a percentage anywhere. Just as
I don't express it that way.
I see that because I haven't seen it, and I thought maybe I missed it, but you were going quickly through some of these.
I don't think that I capture that, David, but that's a good question.
And I'm very much impressed with how you can do these reports through Cirrus. That's great. I've probably wanted that for years.
These aren't through Cirrus. These are just a good old-fashioned Excel spreadsheet.
Oh, I thought maybe you could generate this out of the reports.
No. This is all. This is all outside of. In fact, the financial analysis is completely independent of the point of sale software. I've done engagements for, two other POS vendors, clients with 2 other. So it's completely independent. All the data comes either from your general ledger, QuickBooks, or Peachtree, or whatever. The only difference is the employee stuff. That's either from payroll reports or things of that nature. David, I would love to talk with you on your question. It's an excellent question, and I'll try my darndest to be able to to respond to that, because I think it's would be an excellent addition.
Thank you, Paul. I'll call you back in a little bit. Okay.
Would you help me with that?
Yeah, I'm going to call you in a little bit.
Okay. My number is 515.
Yes.
360 9882. If you wouldn't mind, wait until I'm in the Midwest. So I'm a Central Time Zone. I've got something else that I got to handle right at 11. Here shortly. So after lunch would be preferable, if you wouldn't mind, David.
That's fine. Okay. It'll be later this afternoon. Okay. Thank you. 510 is your area code, right?
No, 515.
Thank you. Okay. Got it.
And then 360-9882.
Got it. Thank you, sir.
All right. Other questions? Then I want to come back to control here just real quick to kind of go into
There are no other questions, Paul.
Okay.
So I know you want to show that report.
Okay. You should be seeing control, everybody. The question that came up to Tuesday was what report in Cirrus provides a significant portion of the data that is used for a pricing evaluation. And I was on it, but I didn't catch it in my feeble mind quick enough. It's under reports, parts and inventory, usage reports, and parts by part type. Now, I don't have a lot of data here, so I'm going to do a search for all, and then I'm going to do a preview, and then we'll just comment on the report for just a second and give you the good news and the challenging news. Okay, this report here is where the source data for history comes from. The report is separated into the different types of parts. So it's going to begin with equipment, and then on my system here, the next group of parts that were used were in the well, this is equipment related to cutters and plotters or printers, and so on. Okay, it shows the order and the quantity that's used. In this case, it's hours, and it uses the cost. All of that is what's captured in this report, and I've got very limited data, but this report is 15 pages, so it's extremely, extremely large. The typical report for a year's worth of data is probably well in excess of 300 pages long. The report does not summarize, to eliminate the history here. That would be wonderful if it could, just give you the total for standard labor, the total for the other parts that are involved, but it doesn't. So it's an extremely, extremely detailed report. I get this report visually so that I can use it as a cross-reference to what the model actually uses. The data source for the example that we looked at Tuesday was, in terms of Excel rows, was just shy of 30,000 rows. So it's an enormous amount of data. And the origin of that was this report in Control. You could always look at it. If you're looking at it for just a small period of time, it's a very valuable and very meaningful report. But if you're trying to look at it for historical purposes over a large period of time, more than a quarter or half a year or a full year particularly, it's going to be overwhelming. But this is the report that represents the major source of data for pricing evaluation. Anything else? We've got just a few more minutes. If anybody's got any other questions.
No, I don't see any other questions.
If not, I want to thank everybody very much for their participation today. I hope it's been helpful. I'm going to shut down here.
Thank you, everyone. Enjoy the rest.
And I'll look forward to talking to you later, David.